Good morning, everyone. It's 10 a.m. on Tuesday, and this is episode 2 of 2022 for 10 on Tuesdays. I'm Holly Hoffman. I'm the owner of the Sales Tax Advisory Network. I'm a former Wisconsin Department of Revenue auditor, and I ran the DOR Speakers Bureau and worked in the Office of Technical Services, where we provided sales tax rulings and private letter rulings, wrote the publications, and from 2015 to 2019, I implemented the sales tax law changes for contractors throughout the state. So that is my background, and I am right now focused on contractor sales and use tax, which basically applies to every business. Whether you are a contractor yourself, or you're a business or an individual, you are purchasing contractor services. And during a sales and use tax audit, you are liable for use tax if you didn't pay it properly on contractor services. And it can be complex for commercial facilities, and we're going to get into that today. Last week, we talked about the difference between real and personal property. And this week, I wanted to move on to talk about what happens when there's a mix. And we talked about last week when it's real and making the determination between real and personal property. You know, we went through the process of, are you just selling materials without installation, or maybe you're purchasing materials without installation? That's personal property. But then when it comes to whether or not a contractor is providing a service, there's additional questions that you need to ask. Is it a service to personal property, or is it a real property improvement or a real property construction activity? And to determine that, you need to look at some other things. There's differences in the rules for whether or not your customer is a residential, that's a residence. It may also be a living facility, so an apartment or a nursing home where people live. It would not apply to a hospital. That's not where someone lives. That's not considered a residence. That's temporary. Uh, a hotel or something like that, that's temporary. But as you can see, the difference in a nursing home or a facility where someone would live in. And then the living area for those types of facilities is the areas that are shared spaces freely open to the residents. So in a nursing home, the residential area would be their room, maybe a craft room, or some have an area for visitation, maybe a dining room, as long as the residents have free access to that area. What area is not considered residential in such a nursing home would be the areas that are restricted. So residents of a nursing home aren't allowed to freely go into the kitchen. They're not freely allowed into the nurse's station. There may be stock rooms or storage rooms that the residents are not allowed in. That portion of the building would be commercial. And then different rules apply for what's real versus personal in the commercial facility areas. Another example of a residence would be for a college dorm or a university dorm. And again, the areas that are open freely to the residents, so their living quarters, their room, the bathroom areas, maybe they have a rec room area. As long as the areas are freely open to the residents, that's considered part of the residential space of that building and fall under the residential tax treatment rules. The commercial areas of a dorm would be the registration desk or the desk area. and any rooms or spaces, offices that are not freely open to the residents. So if the residents have to pay for the rooms, or it's a classroom where it's only open where the teacher, when the teacher is in, or if it's faculty offices, um, office management space, those areas not open to the residents would be considered commercial. So when you're doing a job and it's for a commercial space, personal property is going to be personal property, whether it's residential or commercial. But in a commercial space or facility, if it's real property, you need to take a second step and look at whether or not that real property is serving primarily, which is defined as more than 50% of the time, whether more than 50% of the time that real property is serving a building function or a process function. And if it's serving a building function, that means no matter what business or use that building would have, that facility would have, that item would be necessary. So, for example, three areas that are always considered building function: bathrooms, employee break rooms, and custodial closets. Because if you think about it, those three areas are considered necessary no matter what type of business would be in that commercial space. Other general building function items would be general electrical, general heating, air conditioning, as long as it's serving the building. The ductwork related to that, general plumbing, things like that. Now, what gets confusing is when you're identifying what is process function, what more than 50% of the time is serving a process function. So general electrical from the source up to personal property is considered real property. So if you are an electrician or you own a manufacturing facility and an electrician installs electrical wiring to hook up to a manufacturing piece of equipment, up to either where the manufacturing equipment is plugged in, if it has an actual cord, that is considered real property. So the outlet cover would be real property. If it's a hardwired machine, the electrical wiring all the way up to where it's hardwired to that personal property manufacturing equipment, that personal property item, that is where it's real property up to. Now, what makes it confusing is if there's items that are installed that specifically serve that machine. So some manufacturers or commercial facilities require transformers to be installed in order for the electrical voltage for that machine to be proper. If it's installed specifically for that machine or that equipment, you know, it's before what I talked about where it's connected to the equipment, the wiring, it'll get wired to the transformer, and then from the transformer to the machine. That transformer is considered process function. Another example of process function, and I was just talking to one of my clients about this, is if an item is installed and it serves 100% process function, even though on your Pub 207 chart, it may say, oh, like ductwork is an example. This is a prime example. Ductwork's always real property because it's generally providing a general building purpose. However, there are occasions where ductwork is serving 100% process function. An example would be in a commercial kitchen, you have the vent hoods above the stove and grills and fryers. The vent hoods, even though they're installed in real property, of course, are serving a process function. Also, the ducting from the vent hoods to vent those fumes out of the building is serving a process function. So that is a time when ductwork would be specifically serving a process function. There are situations where plumbing is installed. It's 100% serving, and 100% is my words, but it's primarily serving a business function, a process function. The plumbing's hooked up directly to a manufacturing machine to flush it or provide some type of service for that machine, maybe to cool it, whatever. But it's not remotely related to any general building function or general plumbing. It is 100% serving that machine. So that would be a time where piping would be providing a specifically processed function. So you can see it, there's no absolutes in sales tax, but these are examples that a contractor may run into in determining process function versus building function. And a lot of people have the misunderstanding that if it can be easily removed and doesn't cause damage to the building, that's all personal property. But that's not how building versus process function works in determining whether something is real or personal property. We talked about last week, a reception desk may be built in, cabinetry used to store office supplies is built in, and that's still considered process function. So when I was auditing, that's one of the first things that I would ask contractors: who's your customer? Some contractors serve 100% residential. Maybe they do residential home building. It doesn't mean they don't do personal property work, but it's just a different level of risk when your customers and your clients are commercial businesses. Because then again, there's more things that fall into this process function list. Okay, so another thing we talked about last week was install versus repair. And install is first time installation or complete replacement. So first time you install a toilet versus repairing a toilet, replacing some elements as part of that toilet. Or if you do a complete removal of the entire toilet and replace it, that is still considered an install. And remember, repair includes not just repair, but it's service, maintenance, painting, refinishing, coating, towing, inspection. So inspecting an item to identify if repairs are necessary, that falls under repair for the purposes of sales and use tax. We just shorten it to repair. So just think about that. You may call it different things: diagnostic, a system check, things like that. But installing, I have a great handout attached in the handouts in today's session. And for install, again, first time install or complete replacement, and it goes through a flow chart of whether or not it's considered real personal property. Repair or service, the tax treatment depends on whether you're repairing or servicing or maintaining real or personal property. And again, that falls back to residential versus commercial. And if it's real property and commercial, determining if it's serving a building or process function. Also for repair, something that will cause something to be personal property is the list. So in the statutes we talked about, there is a list. It makes no sense, but anything on the list that was real property when installed is considered personal property for repair. And that's the whole reason DOR created the handy chart at the back of publication 207 that is also attached in your handouts, because the chart identifies those items. It's not all inclusive, but it covers the main items that you would come across that would be real when installed, but are considered personal for repair. The other area that would consider something personal property that you would normally think was real property is if it's not permanently installed, or it's the item installed is installed on property not owned by the person who owns the item being installed. So we talked about the example of the propane tank being leased, and the propane company retains the right to come and remove that propane tank if you break their contract or purchase propane from someone else. So technically, it's not permanently installed and ownership is retained by the propane company. So that's going to remain, even though it may be permanently affixed or intended to be permanently affixed to the property, it's not considered real property. That's going to remain personal property. Another couple examples is utility poles on right-of-way property is currently considered to not be real property, even though it's planted in the ground. And then we talked about communication towers is another common example. Communication towers are often placed on property that is leased, or on buildings where the top of the building area is leased to install that communication tower. So those, even though they appear to be real property, would remain personal property. So that's the third example where it's gonna appear to be real property, but is in fact personal property. And that is why, like I explained last week, that I continue to use the terms real property versus personal property, because it's the sales tax definition, not, it doesn't fall into common sense or what you would personally think is taxable or non-taxable. It's easier to identify what you're talking about because it has its own definition in there. So this week, sorry, that was a long lead up to this week, but I wanted to refresh you and kind of hit some of those points. This week we're talking about not if you're doing all real property work or all personal property work. Most contractors are doing a mix of real and personal property, whether you realize it or not. So an excavator is going to be doing generally real property, but excavating very commonly involves some landscaping. So the first 6 inches, the top 6 inches of soil of the land, removal of trees and shrubs and greenery is all considered landscaping. Okay, stump grinding, all that is landscaping. So if a contractor, if an excavator is coming out to clear a lot for installation or erection of a building, that is going to involve a portion of landscaping, which is a taxable service. So it's a mixed contract, because then they're also digging deeper. They're digging the hole for the foundation. Now that's different than Minnesota. Minnesota law says if an excavator is doing work to construct a building, that's considered all real property. So there's a difference. So if you're working in multiple states, the tax treatment isn't the same. In Wisconsin, landscaping per statute is deemed a taxable service. And that is why we have the oddities of what is landscaping. So excavators are a common example of doing a mix of real and personal property. Like I said, commonly builders, whether they're doing residential or commercial work, will have some elements of personal property in there. If you're a residential home builder, you may not, unless you're including landscaping in your building, in your bid. Other items that might be personal property for residential home builders are certain appliances that are not built in are personal property for install. So a stove or a refrigerator is not built in. Washing machine, dryer, not built in. If they're providing any additional items that are not affixed to the realty, that would be personal property. In a commercial facility, if you're constructing a building for a commercial facility and you're doing 100% of the work there, or hiring subcontractors to do some of the work, your sale is for the entire facility. There is absolutely going to be items that are process function and considered personal property, like built-in cabinets. Maybe it's shelving for finished goods or raw materials. Maybe it's that reception desk, things like that. There is always going to be elements of process function in a commercial facility. So depending on what your contract includes, you're likely going to have a mix of real and personal property. So when you have a mix of real and personal property, and this is either on an invoice or if you're doing a contract, it's based on what you're doing for the whole job of what you're billing for. If it's a mix of real and personal property, how you treat it is generally you're going to treat personal property as personal property. You charge tax. You can buy your materials physically transferred to your customer without tax for resale. And on the real property portion, the sale is not taxable, but you're going to be required to pay tax on all your materials. The only time the treatment is different is if your customer is an exempt entity. An exempt entity does not mean it's a manufacturer or someone who has a use exemption. Exempt entities are government entities, churches, the 501c3s. That is an exempt entity. Exempt entities, you always treat the real property as real property and personal property as personal property for the sales tax purposes. But for an exempt entity, of course, they give you their CES information or their exempt status information. The sale will not be taxable because you got that exemption certificate, which exempts the personal property portion. The materials going into the real property is still taxable. Okay, let me repeat that. For an exempt entity, everything is exempt. You can purchase your materials going into personal property without tax for resale, but materials going into real property are still subject to tax. Your end customer's exempt status doesn't transfer to your purchaser, your purchases, if you're the installer. The exception is if the contract and the work qualifies for the building materials exemption, and that's an exemption claimed by the contractor on their purchases of materials going into real property that become a component part of a facility, and facility is specifically defined in that exemption. It's very limited. It doesn't apply to all exempt entities. There's a limited number of exempt entities that it applies to. It's only municipal level, so city, county level for government entities. It does apply to UW, but not everything for UW. They just expanded it to the clinics and hospitals. But it's a limited number of exempt entities that meet the building materials exemption, and then it's further limited by what's determined to be a facility, and the exempt entity that qualifies has to be the owner of the facility. So either a municipality or the UW has to own that building or whatever facility item that the project is. They have to own it. So if UW or the 501c3 leases that building, they are not the owner, and your materials cannot be purchased using the building materials exemption that go into that real property facility. So exempt entity, and most of your mixed contracts are going to be where you treat real property as real property and personal property as personal property, and then apply any exemptions that apply. There is this construction contract exemption. This exemption is an expansion of the lump sum exemption, and that is if you have a mix of real and personal property and more than 90% of the sales price, your sales price of that contract, is related to the real property construction activities. Whether those construction activities are install or repair, as long as it's real property construction activities, and you're looking at the sales price of the charges related to that real property. So labor related to it, the allocation of overhead, any other fees or items either allocated or that are 100% related to that real property. The sales price of that has to be more than 90% of the total contract price. And it's not just if it's a lump sum contract like it used to be, it's now expanded to time and materials jobs. And time and materials jobs may be work that's spread out over a couple invoices. It's based on that job. So if you have time and materials work, say you're doing a renovation for a commercial facility, you have a mix of real and personal property, because some you're doing a complete replacement and some you're refinishing or repairing existing items. So you're going to have a mix. You want to look at the real property portion and the total sales price. So initially you're going to make a determination, I think this is going to be more than 90% real property, the sales price for this entire project, even though you're billing on a time and materials basis. Or you're thinking, no, this is definitely not more than 90% real property work. So we're going to treat this where we treat the real property as real property and personal property as personal property. Now at the end of your invoicing, you're going to look back and reassess, or at any point in time where it tips over and changes of what you initially thought it would be, you're going to reassess, and you need to adjust or correct your sales tax treatment, your sales and use tax treatment, if it changes from what you initially thought it would be. Let me explain also that the construction contract exemption is not optional. So if your contract or that job on a time and materials basis at the end meets the construction contract exemption, you have to treat that sale in that manner. No one gives you an exemption certificate. Let me correct that, unless you're a sub and you're general or the prime contractor, their contract meets the exemption, then they'll give you an exemption certificate if you are providing a mix sale to that general. But if you're the general contractor working directly with the end customer doesn't give you an exemption certificate. You, the contractor, you, the general, are determining if your mixed contract exceeds 90% sales price related to real property. And then you're required to treat your sale and your purchase for this construction contract exemption. The construction contract exemption says that it exempts the sales of that personal property portion. So basically it is treating the sale as if it's all real property, and the construction contract exemption language in the statutes deems all your purchases of materials as taxable. So you are treating that entire contract as if it is real property. Your sale is exempt. Your purchases are subject to use tax, sales or use tax. So materials going into the real property portion and materials going into the personal property portion. Keep in mind, I said if your end customer is an exempt entity, that this tax treatment, the construction contract exemption, doesn't apply. It does apply, but there is an exception, and it's just simpler to think for an exempt entity, you always treat everything, the real property is real and the personal property portion is personal, because for exempt entities in the construction contract exemption, you are still allowed to purchase without tax for resale items that go into the personal property portion. So for exempt entities, it's treated a little differently. You're not required to pay tax on all your materials. But for general customers who are not 501c3s, this includes manufacturers. Manufacturers are not 501c3s. Farmers are not 501c3s. Farmers and manufacturers are not exempt entities. You would look to see if more than 90% of the sales price of your contract or your time and materials job, so maybe multiple invoices, relates to real property work, and then you exempt the total sales price and you pay tax on all of your materials. And I see I already talked myself through a half an hour and we just stuck on this part. I'm going to wrap this up, answer any questions next week. There are so many examples, and I want to talk more deeply about how this affects a subcontractor. What does the general have to give the sub? How does the sub qualify for the construction contract exemption? It's really important to take our time and really talk through these things. Again, it's not common sense, and you have to learn it and apply it to your specific business. And let me give you a heads up, next week I am traveling to a client's place way up north, and I don't know if I'm going to have connection. I'm going to be doing sales and use tax compliance assessment for them, and this is where I do exactly what I did as an auditor, and I'm looking through to apply all these rules that I'm talking to you about, but in a specific business with that individual, looking at exactly what they do and how do we apply this, the sales tax rules, and exactly what should they be doing. Are they doing a mix? And are their mixed contracts leaning towards a construction contract exemption? How do they know going forward? What's the trends for their company? How should they keep their records and identify these treatments and meet the compliance requirements by the state and what an auditor would be looking for? And it's just so much easier when you go business by business and look at your specific treatment and your activities. So I am going to record in advance and make available to you my next week 10 on Tuesday. So you can either look on my website. I'm going to try to run it if you log in next week for the webinar. I'm going to try to have it set up to run. Otherwise, look on my website or look for the link to the 10 on Tuesdays channel on my GoToWebinar site, and I will have the link for that as well to all of you. And we'll further delve into subcontractors and more about the construction contract exemption and the treatment when it's a mix of real and personal property, because it gets crazy. So thank you for joining me. If you have any questions, shoot them out to me. Those of you who are my clients, you know I'm available for you basically 24/7. So whenever you email me, I try to get back to you right away. If you heard anything today that I talked about that raises questions about what you do, just reach out, let's confirm, let's look at actual invoices and contracts and make sure we are doing it correctly. So I will see you all next week. If you haven't signed up for my Contractor Conference next month, February 15th and 16th, you can either attend virtually or in person. It's the Midwest Contractor Sales Tax Conference. In person is taking place in Beloit, Wisconsin at the Eclipse Event Center. We are doing multi-state. We have Michigan, Wisconsin, and Illinois speakers and revenue departments. And we also have the current and former executive director of the Streamlined Sales Tax Governing Board, who are going to be talking about multi-state sales tax and requirements specific to contractors. So what a great time to learn about a lot of your requirements. I'll be there speaking about Wisconsin. Russ Bradison will be from Wisconsin talking about Wisconsin sales tax for contractors. So don't miss it. Sign up early. Tickets are selling out fast. And if your clients, look for an email from me for a discount on those tickets. So thank you, and I will see you next week at 10 on Tuesday.